Very good evening to all of you. On behalf of Committee for Members in Practice of Institute of Chartered Accountant of India, I welcome you all in this today's VCM on CARO and Schedule 3 of Companies Act. Today we are having with us eminent speaker CA Parveen Kumarji. He is going to tackle one of our technical session that is on CARO, Companies Auditors Report Order. Welcome, sir. Namaskar. Welcome to you, sir. Our another technical session is on Schedule 3 of the Companies Act 2013. In order to tackle that technical session, Deepa madam will be joining somewhere around 6 o'clock. So we are having with us our first speaker, CA Parveen Kumarji. It is my proud and privilege to share with you, all of you, the brief profile of CA Parveen Kumarji. CA Parveen Kumar is a senior partner and national head of Assurance Division of ASA. This organization is having 8 offices with 700 plus team members. He's a chartered accountant with more than 28 years of post-qualification experience. A commerce graduate, holds diploma in information system audit besides certification in IFRS from UK. He has been a member of NACAS, National Advisory Committee on Accounting Standards, Accounting Standard Board, AASB and Expert and Advisory Committee besides various research group and committees of the Indian Institute of Chartered Accountant of India. He's having experience of working on large number of risk advisory assignments, audits, forensic, fraud investigation, and IFRS transaction for various corporates. He's a speaker at national and international forums on his subject of expertise. He's a faculty with reputed institutes like IMT, NAA, Institute of Chartered Accountants of India, Institute of Company Secretaries of India, Institute of Works and Chartered and Works Accountants of India, CAG, NIFM, MCA, IICA, and Delhi University. He has written a book on consolidation under IFRS, Converged Indian Standards, besides papers and articles published in various renowned journals and magazines. He has been invited to present a paper by reputed institutions in Japan, Nepal, Myanmar, Dubai, Singapore, besides various large companies and branches of Institute of Chartered Accountants of India across the country. His personal hobbies include marathon running also. So, without wasting much more time, I request CA Parveen Kumarji to start a deliberation. And once again, on behalf of CMP of ICAI, I welcome you, sir. Sir, please.
Thank you so much, Anilji. Thank you for your generous introduction. And I am grateful to the Institute of Chartered Accountants of India for giving me this opportunity to share my thoughts on this revised CARO. This is very topic nowadays, and almost all the people who are practicing and who are in the process of doing their audits of the companies, they will be requiring a little bit of brainstorming, and significant changes have happened, which will be applicable from April 1, 2022. So this presentation, I have prepared a few slides which I am planning to share with all of you. So what I'm going to do is, we will have a brief discussion on the Company Act, the relevant section 143, 141, 144, and then we will straight away go to the CARO. My focus of discussion will be that what kind of documentation the auditor should prepare and what kind of care one should take while dealing with the CARO, which is to be applicable now. Please remember, this CARO which we are going to talk about is going to be applicable for the financial years starting April 1, 21. So the first closing, which will happen in 31st March 2022 or after that, on those it will be applicable. But in case a company's financial statements are closed for less than 12 months, but their financial year started after April 1, 2021, this CARO will be applicable on that as well. So let us quickly look at section 143(2) of the Companies Act 2013. The section says that auditor shall make the report after taking into account the following: the provisions of the Act, the accounting and the auditing standards, matters which are required to be included, under the provisions of the Act, rules, orders, and they should the auditor should make the report to the best of information and knowledge. So the key point which I wanted to convey to all of you is that accounting and auditing standards are required to be taken into account before you complete your audits. And how will you prove that you have taken the accounting standards and the auditing standards? How will you prove tomorrow that you had taken that into account? Uh, Only way to prove is by creating a lot of documentation. You need to have your checklists, you need to have your work papers, you need to collect evidence from the company, and you need to mention what all activities or what all audit procedures you have carried out after receiving that information from the company. 143(9) of the Companies Act, this is a very significant change in the company law. Every auditor shall comply with the auditing standards. So in the past, in the historical, the way practice was done and the way audits were being done, auditing standards were in line in the direction of uh, guidance to the people who are doing the audit. But now, according to this Companies Act, this is a law. So every auditor shall comply with the auditing standards. So you cannot ignore what is there in the auditing standards. So 141(3) provides for basic disqualification of the auditor. So these disqualification need to be kept in mind when you are planning to pick up or accept an engagement of audit of any company. So any body corporate, other than an LLP or a partnership firm, any body corporate cannot become an auditor of a company. This is under section 141(3). This is a basic disqualification. And any officer of or employee of the company cannot become statutory auditor of a company. This is also basic disqualification. A partner or employee of an officer or employee of the company cannot become auditor of a company. Then the next subclause says that a person or a firm having business relationship, it may be direct or it can be indirect, with the company or its holding or subsidiary or associates, cannot take up the role of a statutory auditor. So this is a very important part. When a person comes up and asks a question that I am doing internal audit of a subsidiary company, can I take up audit of statutory audit of the holding company? Absolutely no. In case you are doing internal audit of subsidiary company, can you become a tax auditor? You cannot. So you need to be careful, when you are doing audit of a company, and before you accept your audit, you need to keep in mind that these disqualifications are mentioned in the Companies Act only under section 141(3). Relative or of a director or of a KMP, key managerial person, cannot take up the statutory audit. So one of the very interesting query which had come, where the husband was a practicing chartered accountant and running his firm, and the wife was a director in a company. So the person wrote a letter and asked a question that, my wife is director in this company. The statutory audit of the company is being carried out by an independent person. Now, while doing the tax audit, I will be relying on the statutory audit, which was done by an independent third party or a third person or, an independent chartered accountancy firm. Is it okay if I take up the tax audit of this company where my wife is a director and that statutory audit under the Companies Act was carried out by an independent audit firm? So the answer is clear. That person cannot take the tax audit of this company where the wife is a director or a key managerial person. Then, person in full-time employment or a person or a partner of the firm holding audits for more than 20 companies on the date of appointment cannot, become the statutory auditor of the company. Of course, there are some exemptions or exclusions which are given in the Act itself. They are like one-person company or dormant companies or small companies and private companies having paid up capital of less than 100 crores. These will not be counted in this 20. But in case an auditor is already carrying out, audit of these 20 companies, they cannot take 21st company as the, as a statutory audit assignment. Now, sometimes the question is asked that, there is a partnership firm and there are two partners who are doing the audit, so whether the firm can take, 25 or more than 20 audits. So it is fine to take that kind of situation, because a person or a partner of a firm, one partner, holding audits of more than 20 companies. So there is a restriction on one person holding, doing more than 20 audits. Then person convicted by court for an offense involving fraud and 10 years have not elapsed, that is also a disqualification. A person who is directly or indirectly rendering any services which are referred in section 144. I'll be discussing about 144, these services, if somebody is providing, then the person cannot take the statutory audit of a company. So these, the statutory auditor who is going to report on CARO needs to keep in mind that there are basic disqualifications of, under the Companies Act. And there are certain other disqualifications also. That person should not be holding any security or interest, it should not be indebted in excess of 5 lakh rupees, or should not have given guarantee or provided any security, in excess of 100,000. Though there is a, relaxation in case of relative, that relative may hold security or interest in the company of face value not exceeding rupees 100,000 face value. So in case, an appointment happens, so there is a 60 days period in which, one may carry out corrective action. Now we move on to, section 144, which provides certain services, and this is a very important clause, or very critical section which one should keep in mind when you are doing a statutory audit and when you are going to report on CARO. Even if the board of directors have approved, the auditor shall not provide the following services, directly or indirectly. This is very critical. So accounting and bookkeeping services is one of them. Then internal audit is another part of it. Design and implementation of any financial information system. It is not supposed to be provided by the statutory auditor. Statutory auditor should not be providing actuarial services, investment advisory services, investment banking services, and outsourced financial services. Now, there are some gray areas. Management services are not supposed to be provided by the statutory auditor as per section 144. Now, what is management service is a matter of debate. So when we look at the reports which have come out, when the NAFRA reviewed work papers of audit firm, they have defined, they have done an interpretation of management services. But, this is still, the matter is under debate. What is exactly the management service and what is not? And then any kind of services which can be provided by the company. So under section 144, one needs to be careful, that these services are not supposed to be provided by the statutory auditor. Now I straight away come to the CARO, which is topic of the day. Section 143(11) provides power to the central government, in consultation with NAFRA by general or specific order, may specify, that what items the auditors can, they shall include in the statement of such matters. And in exercise of those powers only, the central government has issued CARO 2020. So initially, when this CARO 2020 came, the applicability of statutory audits of financial statements was from period beginning on or after April 1, 2019. But later on, in December 17, 2020, this date was revised, and now this new CARO will be applicable for periods beginning on or after April 1, 2021. So the new CARO will be applicable in case you are doing audit of a company and the financial year is starting on or after April 1, 2021. So if your financial year is starting April 1, 2021, after that, then you need to apply that CARO. In case your financial year for which you are doing the audit has started, the beginning of the financial year was at January 1, 2021 and ended on this, December 31st, 2021. It is not supposed to be implemented. So your report will not include the new CARO. You will need to report under the old CARO. So this is very important point, and many times the questions are asked, whether this CARO will be applicable for December 21 closing also or not. So please remember, your financial year for which you are going to do the audit, if that is starting April 1, 2021 or after that, for that financial year, if you are doing the audit, then you will need to apply the new CARO. So there is no change as far as applicability of CARO is concerned, when you compare it with the CARO 2016. So there are companies which are exempted, and those are, banking companies, insurance companies, one-person company, Section 8 company, private limited company, for which I will be discussing the conditions, and then small companies. So on those companies, CARO reporting is not applicable. So I'll discuss about private companies. First condition is that it should not be a holding or a subsidiary company of a public company. So if it is subsidiary or a holding of a public company, then the CARO will be applicable. Your reporting, your statutory audit report must contain, reporting requirement of CARO in case this private company is a holding or a subsidiary. Then, the paid up capital and reserve and surplus, they should be less than 1 crore rupee as on balance sheet date. The borrowing of the company should be less than 1 crore from any banks or financial institution during any point of time during the financial year. So suppose the company has taken a term loan or a cash credit limit. So company has taken a cash credit limit. The limit was, let us say, 95 lakh rupees or 98 lakh rupees. But due to application of interest, 2 days in a year, the amount, has gone above 1 crore. So then you will need to report under CARO. So you need to be careful before you say that CARO is not applicable. Revenue, including revenue from discontinued operation, is less than 10 crore during the financial year. And this revenue will include other income as well. So you need to ensure that all these conditions are met. Then only the CARO is not applicable. So let us say two of the conditions are, so company's capital is less than 1 crore, company's revenue is less than 10 crore, but the borrowing has increased the threshold limit. Then you will need to implement, you will need to report under CARO. So this is very important point, that on which audits you will be reporting under CARO and on which audits you will not be reporting under CARO. Then, basis of the applicability is status of the company as in balance sheet date. So wherever there is a confusion, you look at the balance sheet and you need to look at the status of the company on the balance sheet date. Now, in between 2016 and 2020 CARO, applicability on consolidated financial statement. So there is a change there. Other clauses will not apply, but one clause which is very critical is going to be applied for consolidated financial statement also, which is given in clause 21 of paragraph 3. So rest of the clauses you are not required, but the important point is that one clause is applicable on the consolidated financial statements also. So that means in case there are you've got subsidiaries, you are doing the consolidation, and subsidiaries, in the subsidiaries there are qualifications by the auditors or a negative reporting, you will need to include that and report in your CARO. So there are some important points which you need to consider. The requirement of this CARO is supplemental to the existing provisions of Section 143. So the institute has come out with a guidance note, and that guidance note had already been published in the last year in the month of July, and this is giving a lot of clarifications on various clauses, on how to report in CARO and what are the interpretations and how you need to be careful about. So, but it's not intended to be exhaustive, but it is giving you guidance. But when you are doing audit and when you are reporting under CARO, you need to apply your professional judgment and your experience on various matters which are supposed to be implemented. Now, this new CARO requires reporting on 50 assertions, which are included in 21 clauses. When you look at the previous CARO, there were only 21 assertions, which were included in 16 clauses. So there are a lot of new assertions or the new reporting requirements which have come. And many places there are changes which have happened, when you look at the CARO 2016. The new, or this table which is in front of you, I'm sharing on the screen, the revised clauses, including the sub-clauses, they have been bifurcated. So there are, when we include the sub-clauses also, there are 28 new requirements. And so 28 new requirements have come. 16 requirements, there were modifications, there were changes from the previous CARO. 7 requirements are, as it is, no modifications have happened, and 1 reporting requirement has been deleted. So there are total 50 requirements. So I'll touch upon some of the important requirements here in today's session. Because of the paucity of time, we will not be able to go through each and every clause, but there are some significant changes and some very important clauses which I am going to discuss it with all of you. So I will also be discussing what kind of working paper you need to maintain and what are the issues you need to keep in mind. So when you look at my slide, there are certain words which have been highlighted. So you need to be careful about those highlighted points. So clause 3(2)(b), and this is very important. We have been, wherever we are going and talking to our fraternity, wherever we are discussing with CAs in practice, this point is under significant debate. So clause 3(2)(b), requires you to, report whether during any point of time during the year, from April 1 to, whenever you are closing your financial statement, the company had been sanctioned working capital limit. Sanctioned is the key word, which is sanction is in excess of 5 crore rupees in aggregate from the banks or financial institutions. So from the banks or the financial institutions on the basis of security of current assets, then whether the quarterly returns or statements filed by the company with such banks or financial institutions. So there are statements which can be filed monthly. There might be stock statements, there may be sundry debtor statements, there can be any other statement which is filed by the company on whichever frequency. If the company is filing, or submitting those statements or quarterly returns, whether those are in agreement with books of accounts of the company. If not, then you need to give details. So, a lot of discussion had happened about this, and the guidance note is also giving you guidance on these points. This particular point is you need to keep in mind. You need to see whether there was any amount which was sanctioned in excess of 5 crore rupees. Company might not have utilized that facility at all. So when you are looking at the financial statement, when you are looking at the balance sheet, the balance is, it is showing positive balance in the bank. You may assume that company has not taken cash credit facility, but they might have taken a sanction. Or the amount which is appearing in the financial statement is, let's say, a few lakh of rupees, but the sanction is above 5 crore, then you need to carry out the audit procedures. Whatever information has been submitted by the company to the bank or the financial institution, whether that information is in agreement with the books of accounts of the company. So you will need to be careful. The working capital generally indicates the liquidity levels of the company. That is to manage day-to-day expenses and cover primarily inventory, cash, accounts payable, accounts receivable, and all. This is working capital is calculated basis on these liquidity levels. So the working capital limit could be in form of credit facilities, which are fund-based. That may be a cash credit limit, can be bank overdraft, that can be trade credit. Now, bank overdraft is critical. You need to be very, very sensitive about what is asked, what is required to be reported in CARO, trade credits, working capital loans, purchase or discount of bills, factoring, etc. If you are doing an audit, you will need to check the working capital sanction limit and not the utilization. Utilization may be less than the sanction limit, but reporting is required under this clause in case the sanction limit is above 5 crore. So now you may say that, okay, the company was enjoying credit limit of 4 crores in the previous year, and 2 crore further enhancement was done during the current year. You may say that, okay, in the current year, the amount which was sanctioned was only 2 crore, which is, in addition to 4 crore for which the company was already having a facility. But as if you look at the guidance note, a very clear guidance is given. It includes fresh sanction also, as well as the limit renewed or due for renewal during the year. Even due for renewal is also to be included in addition to whatever the fresh limit. So you cannot take an aggressive view and say that, okay, the previous limit was existing, but it is not yet renewed. Current year, only the additional 2 crore rupees, 4 crore was previous, not yet renewed. This year we have taken a new sanction for 2 crore. So 4 crore plus 2 crore becomes 6 crore. So you need to be careful. Your reporting has to be under CARO in case that kind of a situation arises. Then what you need to do, in order to have your work papers tomorrow, if let's say any regulator, comes and asks you, why have you not reported under CARO, or why have you reported under CARO? What is your work? Where are your work papers? So you need to obtain a list of statement or returns which are submitted to the bank. So in case this company is above that threshold limit of 5 crore, then you need to ask, you need to sort and obtain. That is what you will be writing in your report also, in the front page of the audit report. The auditor, as auditor, we have sought and obtained the information which is necessary to carry out our audit procedures. So you need to seek and obtain a list of statements or return which are submitted by the company to the banks or financial institution, and compare the same with the books of accounts as to its accuracy, or in case it is not, then you need to report. Now, there are many times you need to give statements which are other than what is mentioned, what is relevant to the books of accounts. So guidance note says that, qualitative statements may be ignored. Only those statements or the returns which have relevance with the books of accounts need to be reported. So one thing which is critical out here is that you are not required to audit those statements or returns. So management is submitting stock statements to the bank. You are not supposed to look into those statements and start doing the audit of those stock statements or the debtor statements. All you need to see is whether these are in agreement with the books of accounts or not. So if the company submit submit the returns or the statements on a monthly basis, say for the month of April, May, and June, the auditor in this case would require to verify solely for the month of June being the relevant return at the end of a quarter. So a lot of direction, a lot of guidance is given in the guidance note, and this particular issue has raised a lot of questions, and a lot of people are asking questions in the market, in the fraternity, the auditors, the management, the large companies, because they have been taking facilities from various banks and they are submitting a lot of data, a lot of information to the banks. So what exactly is required to be reported, what exactly is not required to be reported, and whether the auditor, how the auditor is going to make sure that these are in agreement with books of accounts. They, as auditor, you need to exercise your professional judgment to determine, the materiality and the relevance of the discrepancies for the users of financial statement while reporting under this clause. You also need to remember, your objective of, financial statements, your audit. You need to, so there are certain basic principles which are given in the framework of accounting standards, the auditing standards. The framework, one of the basic principle is that you as auditor will look into the relevant information and you will take into account the materiality. So company with a turnover of, let us say, 50,000 crore, and then there is a discrepancy of few lakh rupees, whether it is important for user to know that there was a discrepancy of this much or not, that you will need to decide on the basis of your professional judgment. So this is one clause, and another clause which is which is attracting a lot of attention these days. This is clause 319. and it is critical that you spend your time on this, look into the guidance note related to this, and you need to create your work papers so that tomorrow, if this is a new requirement of the CARO, and if a regulator asks you how have you carried out, how have you reached to the conclusion what you are reporting in this CARO on this particular 319, you need to make sure that you have enough working papers with you. You have done your calculations properly. You have taken, you have sought and obtained the information from the company, in this regard. So what this 319 is saying, the basis of your opinion. So this clause is asking you to give an opinion. And this is what has been highlighted in the slide in front of you. You need to provide opinion on this. And what will be the basis of your opinion? It is written in the clause 319 itself. On the basis of financial ratios, aging, and expected dates of realization of fixed assets. So this is your basis, the ratios, the aging analysis, and expected dates of realization of financial assets. And also the information related to payment of financial liabilities and other information accompanying the financial statements. What is that other information? It can be director's report, it can be annual report, it can be internal MIS, whatever is the other information which is accompanying the financial statements. And also you may say that it was all not there, but it was in my knowledge. So the auditor's knowledge of the board of directors and management plans, on the basis of all these, the ratios, the aging, expected date of realization of financial assets, payments of financial liabilities, expected dates, other information accompanying the financial statement, and auditor's knowledge of board of directors or the management plans. So whether the auditor is of the opinion that no material uncertainty exists, no material uncertainty exists on when, as on the date of audit report, and about what, that the company is capable of meeting its liabilities existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. So you need to be careful about reporting under this clause. It has got a direct relationship with your going concern assessment. So Standard on Auditing 570, which was revised, and it talks about the going concern. You need to see and you need to collaborate. You need to keep that in mind, that you might have looked into the going concern issue. So this is slightly more specific. So what you are going to give is your opinion whether no material uncertainty exists as on the date of audit report, that the company is capable of meeting the liabilities which were existing on the balance sheet date as and when they fall due within a period of 1 year from the balance sheet date. So very tricky language which was used, very specific language which was used by the people who were preparing this CARO requirement. So now as auditors, you need to have all these things in your working paper file. You need to have financial ratios. You need to consider that also. So you need to the paper on which you have calculated financial ratio, you may say that okay, this is fine, this is not bad, this is fine, this is fine, this is not good, and there is a question which you have with the company, and what was the answer which was given by the company. Aging analysis and expected date of expected dates of realization of assets and expected dates of payments of financial liabilities. You need to have both prepared in your work papers. What are the other information in your knowledge? Whether the director reports was available when you signed the report, whether the draft of annual report was available or not. When you are, this is something which is very critical out there. When you are reporting under US regulations, they would ask you to consider the information. So generally what they do is they prepare draft of that annual report and submit to the auditors while they are preparing their audit report. So in Indian circumstances also, the draft of director's report and draft of annual report can be obtained. But in case the company has not taken it, you will need to mention in your work papers that you have not obtained or it was not ready, the director report and the annual reports. So whatever information was there, accompanying, and most importantly, whatever was there in your knowledge as an auditor, suppose you have given a projected, so the company might have given some kind of projected financial statements to somebody, and they might have come to you as auditor or as statutory auditor or as a professional to give your, some kind of certification or some kind of report on that project report, and you might have given some kind of opinion on that. So you need to keep in mind that during the year they had made some kind of projected balance sheet and your signatures and your report was there. You need to consider that as well, and then you will need to carry out your audit procedures. So this clause is very it's very interesting. It's very complex. Your work paper need to be very, very carefully drafted. You need to obtain the detail of liabilities which were existing on the balance sheet date, along with their due dates, and ascertain which were falling within 1 year. Then you will need to see whether the subsequent payments have been done, when after the balance sheet date and the date of audit reports. And then whatever is unpaid, what is the position, whether the financial assets are realizable and you are able to, the company is able to repay those liabilities or not. So your assertion will be, your assertion will be in a negative sense, in a negative assurance direction. So nothing came to our notice will be the starting line. But please remember that you are also doing your audit procedures in order to understand the going concern issue. So in case you realize that these liabilities are not supposed to, there is some challenge there, you need to go back to your going concern, and then you will need to see what is the what is the basis of your assertion on the going concern. So these two clauses, very, very significant one. Now we move to another subclause which is new, which is related to property, plant and equipment and intangible. So clause 3(1)(a) says that whether the company is maintaining proper record showing full particulars including quantitative detail and situation of property, plant and equipment, and whether the company is maintaining proper records showing full particulars of intangible assets. So you need to ensure that your work papers are maintained in such a manner that intangible assets should be maintained by the company. So 3(1)(b), let us read that also accordingly. Along with this, whether these property, plant and equipment have been physically verified by the management at reasonable intervals, whether the material discrepancies were noticed on such verification, and if so, whether the same have been properly dealt with in the books of accounts. So very specific requirement by the CARO, the new CARO. Now, interestingly, there are some questions which might come into your mind, that what is intangible and whether the company is maintaining records. But I think one important aspect which we all should remember as practicing CAs and the people who are giving reports, audit reports under the Companies Act, one important point, that fixed asset word has been replaced everywhere. Now it is PPE, property, plant and equipment. So I have seen some of the balance sheets which are still using the word fixed assets. But please see that the financial statements which you are auditing, they are carrying the correct terminology, which is property, plant, and equipment. Basically, they are aligning. These are aligning your Ind AS, AS, and IFRS. So in any case, intangible is not a fixed asset, so you need to be careful about writing fixed assets. So now you will also need to include the investment property and non-current assets held for sale. So there is a unit which is a non-current asset and you have held for sale. So you need to go to standard 105 Ind AS and understand what are the requirements of that standard. So you need to consider that as well. Then somebody had asked a question in one of the sessions, that whether there is any format which has been given. So for this, there is no format, but basically you are an auditor. You know what has been asked. So if the company is maintaining records, which is providing the information which you are asking for, then that means that those records are sufficient. So it also depends on the mode of account keeping, whether they are having an ERP, or whether they are maintaining under Tally, or whether they are still using the manual books of accounts. It will also be dependent on how many locations they have, what are the control systems they have. So all these things need to be taken into account when you prepare your work paper and when you report under this new CARO. So somebody may say that the company is not maintaining property, plant and equipment register. So this is a serious documentation issue and it is a serious control lacuna. So when you are reporting under CARO, you will need to mention under this clause in case the register is not maintained by the company. So now the next question which many people they ask is what is about this physical verification concept. So basically, what is reasonable interval? I would say that this is something very, very subjective. It depends on the circumstances of each case. So is it somebody asked a question, that is it necessary for the management to physically verify all the assets annually? Then you need to go to the guidance note and see what is the reasonable interval. That will be dependent on your professional judgment. Whether once in a year sufficient, whether it is not sufficient. There may be a situation that company is doing physical verification every quarter, and there may be a situation that the company is doing a physical verification every 2 years. So depending on the size, the complexity, the units, and the kind of product, the raw material, it depends on all those circumstances. And you will need to make your professional judgment whether this is reasonable or not. Also, discrepancy, whether it is material or not, you will need to understand that your reporting is based on materiality. So whatever reporting you are doing under CARO, in this particular clause, there are certain clauses where the materiality concept will not play. You will need to be specifically mentioning, mention all those non-compliances. But in this particular clause of reporting under CARO, you will need to keep in mind, the materiality aspect as well. Now, 3.1c gives you a table, which is an interesting amendment, a modification in the previous clauses. So whether the title deeds of the immovable property, disclosed in the financial statements are held in the name of the company. So this is, a clause which will require your immediate attention. If not, if they are not held in the name of the company, provide the details thereof in the format. So now the new CARO will have a format, and this I see a challenge when you are doing audit of a small privately held group. Many times, the promoters might be owning the property. The title deed might be in the name of the promoter, but there may be a agreement signed with the company, but the title of the property might not have been shifted to the company. You will need to specifically mention those. And here, the table wants you to have a description of the property, the gross carrying value, the amount which has been mentioned in the balance sheet, then in whose name this title deed is, and then whether that person is a promoter, a director, or a relative, or an employee, and then period for which it is held, and then why it is not in the name of the company. What is the reason? In case there is a dispute, you need to mention that detail here. So when we do the analysis of this particular clause, we need to see that the property, plant, and equipment and intangible in this particular clause, the details have to be given in this format. You will need to seek and obtain information from the company, and this is a sensitive matter. Many times property title deeds are held in the name of promoters, so then you will need to mention their name. And then it excludes the leased property. So whether there are discrepancies in the lease agreements or it is not fully executed, in such case you will need to see, it will be prudent if you include the acts of such cases as well. Peculiar situation will be that the title deeds are kept with the banks, or the mortgage, and they are in the custody of the bank. Then what do? The company may come and say that, okay, we do not have access to the title deed, we only have a photocopy of that. You're not very sure whether the photocopy is the latest one. You have not seen the original title deed. So you may write to the bank and take a confirmation. You may write to the financial institution and take a confirmation. So somebody may come up and say that, okay, we lost the title deeds. So what do? You cannot rely on the photocopies again, because ultimately it is your responsibility. Whatever facts you are mentioning in the report, which is given under CARO, you need to obtain, FIR copies and evidence which will say that, okay, this was actually lost. Then in case there is any dispute because of which title deeds are not transferred, there may be some restriction in that jurisdiction where the land or the building is there, and the title deeds, so there is some kind of dispute or some kind of restriction. You will need to mention that detail in the remarks column of that table. Continuing with property, plant, and equipment, there is a new subclause which talks about revaluation, and this will be an interesting reporting. Whether the company has revalued the property, plant, and equipment, including right to use assets or intangible assets, or both during the year. And if so, whether the revaluation based on valuation by the registered valuer, then you specify the change. If change is 10% or more in the aggregate, so you will need to mention about it. So you will need to consider requirements of AS 10 and AS 16, that if a single item of PPE is revalued, then the entire class of PPE to which that item belongs should be revalued. It cannot happen that you will revalue only one portion and other portion you will leave it like that. You will need to revalue the whole part of the whole group. Then the clause require disclosures. If the change is due to if there is a 10% variation, is whether it is in each clause or not. Then you also need to consider the requirements of section 247 of the act, which is talking about valuation of the registered valuers. So there are many other clauses, many other amendments which have come, but we will stop here. We will, not discuss all of them. We do not have time to discuss all these clauses. So just to recap what we did, in previous 50 minutes or so. So we looked at the Companies Act. We looked at section 141. We looked at section 143. We looked at section 144. We looked at disqualification of the auditors, and we looked at the section 143(11), which provides power to the central government to give these kind of instruction. From there, we moved on to the CARO. We looked at comparison between 2016 and 2020. The applicability of the new CARO, which is going to be for the financial years. If you are doing an audit of financial statements, which are starting, the financial year of that is starting from April 1, 2021 onwards. Only on those financial statements, the new CARO will be applicable. Any other, financial years which are, which had started before April 1, 2021, you will be applying the old CARO requirements. So the applicability, we looked at the thresholds for private limited companies. We looked at, which are small or one-person companies where it will not be applicable. So once applicable, we looked at some new changes which are happening in the reporting requirement. So these new changes are very important. So 319 we looked at, which is to report on whether the financial assets, whether the liabilities, whether so you will need to make an opinion whether the financial liabilities existing on the balance sheet date, whether within 1 year those financial liabilities can be met, and the basis will be the financial ratios, the aging, realization of your financial assets, payment of financial liabilities, other information accompanying the balance sheets, and auditors' knowledge of management and the board of directors plan. You will need to consider all this, and you will need to make an opinion. And then there was a requirement. There is a new requirement where the company is providing statements and quarterly reporting to the people, to the banks or the financial institution from where they have taken the working capital limit. You need to keep in mind the sanction limit of 5 crore, and you need to see whatever information has been submitted, whether they are matching with the books of accounts or not. And then we have looked into certain clauses where property, plant, and equipment. We saw that the word fixed asset is not supposed to be used. We saw that what is reasonable interval, how you need to report in case the title deeds are not in the name of the company. So so this is a brief recap of what all we had discussed in the CARO. So I think our other technical guys with this, I stop my presentation, and thank you very much once again for providing me this opportunity to share thoughts with all of you. And I'm grateful to the Institute for the opportunity. So over to you, Anil.
Thank you, sir. Thank you, sir. We are having two, three questions. So I would like to ask on behalf of the members. So one question is, the new disclosure requirement includes details of the title deeds of the immovable property not held in the name of the company in the prescribed format. In case of joint venture where the asset is in the name of the operator and the value of the asset is considered for proportionate consolidation by non-operators, how does the reporting requirement be satisfied?
So you will need to see in the balance sheet, in case the company is disclosing that asset, the land or building in the name of the company. If they are showing it as land and building, then you will need to see whether the title deeds are in the name of the company. In case the joint venture, in case the company is applying, equity method of accounting, and they are just putting that investment in joint venture as one of the line item, then it is okay to have it in the name of that joint venture.
Okay, sir. Another question is, sir, do we need to report the aging of sundry debtors in the CARO report?
Yeah, that is a very interesting question. That should be the basis of your opinion as auditor. The aging and the ratios. So I think Deepa ji will be talking about Schedule 3 requirement, which is a responsibility of the management to make a disclosure. So the CARO report, you will be mentioning whether in your opinion, there is material uncertainty and if it is there or not. And what is the basis of your opinion? That will come from the reporting which has been done by the management.
Another question is, I think you have already taken in your deliberation CARO and Schedule 3 of the Companies Act 2013 applicable from which financial year? I hope you have already covered in your deliberation 1st April 2021. Before that, it is old CARO, and after that, it is.
I discussed it 3 times. So those
yes, sir. Yes, sir.
May look at the recording.
Yes, sir. Yes, sir. Yes, sir. Yes. Please clear that if the firm have 2 partners and one partner is signing the large company audit of 25 companies, excluding the exempted companies.
Yeah, that's okay. That is also, I have answered a question in my discussion that per partner 20 companies are allowed.
20 companies. In CARO 2020, applicable to companies audit, applicable to the audit of companies for the financial year 2021, this has already been covered. Do all the conditions apply concurrently for a private company also to be exempt from CARO?
Yeah, I discussed about that private company. So in the recording, you can see that slide where, all those conditions are necessary.
Yes, yes. Whether financial institution includes NBFC 2 for clause 3 subsection 2 subsection B?
Absolutely.
Okay, sir. If sanctioned working capital limit exceeds rupees 5 crore, however, the advance having become an NPA, so the bank has recalled the CC account. Will the CARO with respect to this working capital facilities apply?
I mentioned it very clearly, sanctioned anytime during the year.
G.
So if it is sanctioned anytime during the year, after that, whatever has happened, it's a matter of, it's already done. So you have already touched that point.
Thank you very much, sir. These were the few questions we have received from our members. So once again, on behalf of the Committee for Members in Practice of Institute of Chartered Accountant of India, I heartiest thanks for your sparing your valuable time for the wonderful and knowledgeable deliberation, sir. Thank you so much.
Anilji, in case any other question comes up, I will be glad to answer. You can write an email and
yes,
we'll
sir.
be glad to answer. And
surely,
I'm really looking forward to listen to Deepa ji now.
Sure, sir. Sure, sir. Sure, sir. So we are having CA Deepa Agarwal ji with us. Welcome, ma'am.
Thank you.
She is going to cover the Schedule 3 of the Companies Act. It is my proud privilege to share the brief profile of Deepa Agarwal ji. Deepa Agarwal is a BCom FCA with 13th rank in all over India and 5th rank in Northern region. She has almost 20 years of experience in serving national and multinational companies in the areas of auditing, accounting, corporate laws, and other related matters. She has completed Information System Audit ISA course from the ICAI in September 2006 and certificate course on IFRS from ICAI in March 2011. She has worked with the Technical Directorate of ICAI for around 5 years and has assisted ICAI in various publications such as Background Material on Accounting Standard 16, technical guide on accounting and auditing issues in chit fund, technical guide on internal auditing in case of intangible assets. She has been working with a renowned consultancy firm since almost 12 years. Currently, she is working as an associate partner, member of E&Y with the SR Battery and Company LLP. She was a special invitee on AASB of the ICAI for the last 2 years and special invitee on Corporate Laws and Governance Committee of the Institute for the year 2019-20. She has worked extensively on the publications, projects and assurance standards. She has authored 2 publications titled The Law and Practice of Financial Reporting Requirements and Auditors' Responsibilities under Companies Act 2013, released in the June 2016, 2017 and January 2018. A complete guide to interim financial reporting released in January 2017. She has worked extensively on preparation of comments, guidance and presentation on Companies Bill and Companies Act 2013. So, without wasting much more time, I request Madam Deepa Garbalji to please enlighten all of us on the various intricacies in the Schedule 3 of Companies Act. Madam.
Thank you for such an extensive introduction. And I was hearing to Praveenji, I think you have explained in a very interesting and wonderful manner about CARO, talking about what is a responsibility as an auditor. And now from auditors to, I will be moving to preparers, right? So we'll be talking much about the financial statements, and then comes the role of the auditor. So I think on my profile, I am currently also a member of the Corporate Laws Committee, and I think all of you would have noted the exposure draft which has been issued by the Corporate Laws Committee, yesterday morning, and on Saturday morning they have issued the exposure draft. Much of the guidance, much of the issues would have addressed, but for those who believe that the issues are still open, I would encourage all of you to give your comments, share your comments before the deadline of 10 September. So with this, I will share my screen and just take you to the presentation directly, because I think both of us, Praveen ji and myself, we are covering very extensive topics today. And it's very difficult to cover these topics fully, going to all the issues in just 1 hour. So I'll also try and focus on the important issues, also talking about the guidance given by the exposure draft in between, which is relevant for you. I think in the beginning, has already clarified and made my job simpler about talking about the applicability date. So these amendments are effective from 1st April 2021. Except some amendment to the accounts rule and the audit rule about the audit trail, which I will cover subsequently in a slide. So MCA issued the notification on 24th March, wherein they made substantive amendments to Schedule 3. So as Praveenji explained you about the CARO, the corresponding revisions have been made now in Schedule 3, and the disclosures are required by the companies as additional disclosure under regulatory information. So now, in addition to the other changes, they have introduced substantive changes, and I'll try and cover the implementation issues in between. So there are 3 divisions: Division 1, 2, and 3. One is for your Indian GAAP Companies Accounting Standard Rules 2006, and second is for your Ind AS, and third one is for your NBFCs. So the guidance note also, if you will see, the exposure draft have been released for all the 3 divisions, which are applicable depending on what is the financial reporting framework for the company. There are changes in the board report as well, which I will cover subsequently. Now, one important change, which I want to cover on this slide is on the comparatives. So the general instructions mentions about that for every financial statement, the company has to provide the comparative information for the immediately preceding reporting period, except in the case of first financial statement. So which means there is no exemption from the preparation of the comparatives. So you should start thinking about the comparative information when you are playing the role of the auditor as a company's to when they will prepare the financial statement for March 2022. So the exposure draft also clarifies it that for the financial statement prepared for the financial year 21-22, corresponding amounts need to be given for the financial year 2021. So the first step is start preparing for comparative information. There are enhanced disclosure for companies to which Indian GAAP and Ind AS is applicable, and for NBFCs. So I've structured my presentation in a manner so that I can take you through the important changes in Ind AS, and also at the same time, what are the changes made in the Indian GAAP Division 1. The company should assess and make changes to the existing systems, control, and processes. So for example, I was listening to the deliberation on the working capital and on so many new requirements which have come up in CARO. So the company will have to start setting up those systems, or for example, the whistleblower reporting, which has been made mandatory now and will be there in CARO 2020 with effect from the next financial year. The audit trail feature, though it is applicable from 1st April 22, however, my suggestion will be to start thinking, and because we are just 6 months away from its applicability. So the companies will have to set up, will have to invest in they have to understand wherever they are using an accounting software for the maintenance of books of account, they will have to set up the systems and set up the software or the accounting software in a manner so that they have an audit trail feature. Also with effect from, since statutory audit is a mandatory requirement for all the companies, the changes in auditor's report, which I will cover in subsequent slide, which it will be applicable for all companies. So there is no exemption as such for private company or smaller companies. It is applicable for all the companies. And the change in relation to the board report shall be applicable on all the companies again, which are there in Companies Accounts Rules 2014. Also, one important point I would want to highlight on the exposure draft, the guidance note provides clarity on the applicability and extent of the disclosures to be given in the CFS. There was no guidance before this. So the exposure draft currently mentions that the requirement of India's Schedule 3 shall apply to a CFS subject to the specific exemption modification based on the relevance to the CFS. So if you remember, the current Schedule 3 also refers to the relevance that the notes which are relevant in the context of CFS should be given by the companies. So the guidance note provides further detailed guidance. For example, for analytical ratio, the requirement is not relevant at the CFS level, and hence the company may not disclose in the CFS. So now this is again, as of now, it's an exposure draft only. So you wait and watch for the final guidance note. And they also suggest a materiality threshold. They say, for example, the security of current asset against borrowing, if the disclosure is required for a CFS, then you need to evaluate that whether disclosure is material to the group. That is, whether it is more than 10% of the respective balance sheet item in the CFS. So that are some of the, the guidance and the new issues which are there, or the guidance in the guidance note, which one should refer and see, how much guidance and relaxation is being given. Now moving on to the next slide, I think this is a minor change. There have been changes to the nomenclature. So if you look the way the slides are structured, the left-hand side, you can see the old clause and then the revised clause and then the type of the change. So the term turnover has been substituted to total income. The rounding off has been made mandatory for companies to which Indian GAAP is applicable. Currently, it is mandatory for companies complying with Ind AS. So for all those companies which apply Companies Accounting Standard Rules 2006, they will have to apply. They will have to comply with this mandatory rounding off principle as per revised Schedule 3. Further, the heading under non-current asset for companies preparing balance sheet under IGAP have been amended, and property, plant, and equipment they have amended it to property, plant, and equipment and intangible asset. So presentation change for companies to which Indian GAAP is applicable. Now moving to another very important and interesting disclosure regarding the promoter shareholding. So disclosure of shareholding of promoters and percentage of change is required to be given as per the new Schedule 3. Identification of promoter will require a careful evaluation and assessment of the fact. SEBI regulations, if you look at the SEBI LODR regulation, listing regulation, which are applicable to all the listed companies, that requires details for promoter as well as promoter group. However, amended Schedule 3 information is limited to only to promoters. Now again, as per the exposure draft, the prescribed format requires disclosure only in respect of shares held at the end of the year. So if you look at the heading, shares held by the promoters at the end of the year and percentage change during the year. The guidance note further recommends that the company should also disclose number and percentage of shares at the beginning of the year. A percentage change during the year that needs to be computed with respect to the shares held at the beginning of the year or where shares have been issued for the first time during the reporting period. Such percentage change needs to be computed from the date of issuance. So for example, if the shares have been issued for the first time in the month of August, then the opening date should be construed from August rather than April, which implies that if from the month of August till March there has been no change, then the percentage change should be reported as nil. So the guidance has been given in the guidance note regarding promoter shareholding, but again, this is very important change. The definition of promoter should be as per Companies Act 2013. And somewhere the listed companies were already making these disclosures, but now considering this will be part of Schedule 3, then it will be applicable for all the companies. There's a minor change on short-term borrowing, earlier required to be disclosed under other current liabilities. And now it has to be disclosed under short-term borrowings. Now I'm coming to some of the important disclosures made for trade payable, and you will see similar kind of aging analysis for your trade receivable, for your CWIP, for your intangible assets. So if you look at the earlier the companies, or you can say for March 21 also, the companies were only required to disclose trade payable, but there was no requirement to provide aging details. The disclosures now will mandate the company to disclose the aging payment cycle both for MSMEs and other than MSMEs. And they have also asked for disclosure between disputed and disputed use to MSME and disputed use to others. What is disputed has been the guidance is covered in the exposure draft. And it also requires that similar information shall be given where no due date of payment is specified. In that case, disclosure needs to be given from the date of transaction. So even if there is no due date, you have to capture the details in this table, and unbilled dues shall be disclosed separately. So a kind of more of the number of the disclosure and the changes which Schedule 3 has introduced. I think that's more of the additional burden on the companies, and the companies should start thinking about the information system and the processes they need to set up for collating the information and giving to the auditors on a timely basis. Moving on to the next slide, these are some minor changes in the other current liability. They have deleted this current maturity of long-term debt because these will be required to be disclosed under short-term borrowings. Long-term loans and advances, they have removed the security deposits, and now that will be included under the heading other non-current assets and other financial assets. Now this is the change which I think you just would have heard Praveenji on CARO, that and they have added the auditor is required to talk about that if the change is 10% or more in the aggregate of the net carrying value of each class of property, plant and equipment. So corresponding change they have made in Schedule 3, and the amendment in disclosure for tangible and intangible asset has been added to align it with the requirements of in CARO 2020. Also, this change is both downward and upward. So that revaluation can be your upward revaluation or a downward revaluation. So now companies will need to specify the amount of change if change is 10% or more in the aggregate of the net carrying value of each class of PPE or intangible asset. An auditor will be required to report in CARO when signing the audit report in the next year. Similar disclosures have been introduced for intangible assets as well, in addition to the tangible assets. Some other changes. So in other non-current assets, they have added the security deposits. For India's companies and other financial assets, under the other current non-current asset, they have also added the trade receivable, which is there on the next slide. And let's go to the next slide to understand the detailed disclosures required for trade receivables. So this is a slide wherein they have added the aging analysis and the schedules separately for the Indian GAAP companies and for the India's companies. So if you look at the the split, they require the companies to give the outstanding amounts for trade receivable for less than 6 months, 6 months to 1 year, and for so on for more than 3 years. And for the India's company, they have just bifurcated this for the, again on a similar lines, but under undisputed trade receivable considered good. So largely in line with what you are doing currently, but currently you do not disclose it for, as per the aging analysis, the way they have asked for now. So this is again an enhanced disclosure requirement, and the companies will have to find out to give a proper analysis of the aging of the debtors. And I think as an auditor, we need to look at the amounts which are outstanding for, let's say, for more than 1 to 2 years or for more than 3 years. So look at the reasons, understand from the management why these debtors are outstanding and what are the reasons, what are steps have been taken by the management to ensure the recovery, and whether these are not fictitious debtors. So I think the responsibilities have been increased for the companies as well as the auditors. So similar kind of a note is there as we have seen in trade payable. So similar information shall be given where no due date of payment is specified. In that case, disclosure shall be from the date of the transaction, and unbilled dues shall be disclosed separately. The next is, so this is a new insertion. So it talks about it where the company has not used the borrowings from banks and financial institutions for the purpose for which it was obtained. So for example, if a company has obtained a loan for construction of a building, but they have, instead of construction of a building, has utilized it for its working capital purposes, or have given it loans to its subsidiaries, so then they have to make a specific disclosure here. When you will refer to CARO, a similar kind of a disclosure reporting is required by the auditor for the borrowings. So again, this is one change which they have introduced for the companies, that the companies will have to make a disclosure first. And here there is a minor change. They have just added intangible assets that which the board have to mention that if in the opinion of the board, any of the assets other than PPE and intangible asset and non-current investment do not have a value in realization in the ordinary course of business, at least equal to the amount at which they're stated, the fact that the board is the opinion shall be stated. So they have included the intangible assets category as well, in addition to the PPE and non-current investments. Now I'm coming to a very important section on the additional regulatory information. So this, and now I think you can easily correlate, because you have heard Praveenji about CARO, how the changes have been made, enhancement of the auditor's responsibility. So I think now it will be easier for the auditors to report once they have this information from the company included in the financial statement. So if you look at the format on the first point, title deeds of immovable property not held in the name of the company, this is in line with CARO, and such disclosure is required for your property, plant and equipment, investment property, PPE retired from active use and held for disposals and others. So description of the item has to be given, gross carrying value, title deeds held in the name of. So if it is not with the company for any reason, let's say because of the merger or amalgamation, it is still in the name of the transferor company, or it is pending with some other authority, or there could be any reason it is with bank, then it has to be mentioned here. Now, additional focus is on the relative promoter. So you will see that at many places, the regulators continue to enhance the focus on the related party. So if you will see, they have specifically added whether title deed is a promoter, director, or relative of promoter, director, or employee of promoter, director. So they're just trying to see that whether title deed holder is a promoter, director, and the additional disclosures are required, and property held since when, and reasons for not being held in the name of the company. So now the auditor will have to give this tabular format instead of the paragraph format given earlier. The second change is where the company has reevaluate its property, plant and equipment, intangible asset. Now a disclosure as to whether the revaluation is based on the valuation by registered valuer as defined under Rule 2 of the company's registered valuers and valuation rules needs to be given. Again, this disclosure is in line with CARO reporting by the auditor. And then in the next slide, you can say, you can again see there's a continued increased focus on related party transaction. Loans or advances in the nature of loans are granted to promoters, directors, KMP, and the related parties as defined under Companies Act 2013 needs to be disclosed if they are repayable on demand. So if they're repayable on demand or without specifying any terms of period of repayment. Similar kind of disclosures here in CARO 2020, but this is something, which the regulator has brought in to companies to specifically disclose, which are the loans given to the promoters and directors, and the guidance, the exposure draft clarifies what is repayable on demand, loans, advances in the nature of loans. So the explanation which is there in guidance note on CARO 2020, so my explanation is there in your exposure draft of the Schedule 3, which talks about that if the advance is not as per the normal trade practices, then it is construed to be advance in the nature of loans. So again, it depends on the facts and circumstances, and one has to make the disclosures. Now, this slide talks about the the aging schedule of CWIP and your intangible assets under development. So, for aging schedule of CWIP needs to be given for projects in progress and projects temporarily suspended. Same needs to be provided for the intangible assets as well. Where completion is overdue or has exceeded its cost compared to its original plan, CWIP completion schedule shall be given. Similar to the disclosure has to be given even for the overdue or has exceeded. So again, the companies will have to think about what was the original plan, which was the original budget, what are the processes to capture whether the cost has exceeded the budget. So I think this is a very detailed additional efforts will be required by the company, and then the auditor who will issue an audit report. Not just CARO, the auditor will also talk about the financial statement, giving a true and fair view. So the moment these additional disclosures become part of your the financial statement prepared by the company, the responsibility is automatically there on the auditor, because the auditor will talk about in the basis of pane and paragraph that they have based on the examination of the financial statement along with your schedules, notes, and information given in the financial statement. So it's not just about CARO. So the point I'm trying to highlight here, the information the management will be given in the financial statement will have to be kind of verified by the auditor. Similar kind of disclosures are there for your intangible assets under development, wherein the aging schedule is required for projects in progress, project temporarily suspended, and for your where completion is overdue or has exceeded its cost. So you will have to think about here intangible assets in development, which are the intangible asset, whether qualify for capitalization, whether do not qualify for capitalization. For Benami property, this disclosure is another step to improve transparency for the stakeholders, as they will have to disclose any proceeding that has been initiated or pending against the company for holding any Benami property, and also provide a status and view on the same. CARO 2020 requires auditor to report whether any proceedings have been initiated or are pending against the company for holding any Benami property. So now companies will need to assess on a case-to-case basis whether any disclosure is required for contingent liability or provision is required in the books of account if there is any such proceeding pending. So one has to look at the definition of the Benami property under the Benami Transaction Prohibition Act. Identify such proceedings, whether such proceedings have been initiated, and the disclosures have to be given under these headings. The nature of the proceedings also to be given, the status of such proceeding, and the company's view on the same. Moving on to the next slide, this is about so one important difference here is that in CARO, the auditor has to report if the borrowings exceed 5 crore, if the amount of loans sanctioned is 5 crore. But here the company has to make a disclosure whether the company has borrowings from banks or financial institution on the basis of security of current asset. It shall disclose whether quarterly return or statement of current assets filed by the company are in agreement with the books of account. And if not, a reconciliation has to be given with material discrepancies. So here you can see there is no threshold defined here. So which means this clause requires the companies to report on the borrowings obtained on the basis of security of current assets and whether these are in agreement with the underlying books of account. In willful defaulter, so this disclosure again is to align with CARO 2020. So here the company has to make a declaration, or rather a specific disclosure, whether the company has been declared as a willful defaulter by any bank, financial institution, or other lender. Now, the CARO guidance note provides a specific guidance that this other lender should be limited to your government organizations, because declaration of borrower as a willful default by the lenders other than those covered by the RBI circular may not have been possible in a transparent manner, and therefore government or government authorities by virtue of their powers may be in a position to declare any borrower as a willful defaulter. So it could be by Reserve Bank of India, or it could be by any other bank or financial institution, or by any government or government authorities. As per the exposure draft of Schedule 3, it is possible that the company may not have been declared as a willful defaulter as at the date of the balance sheet, but has been so declared before the financial statement are approved for issue. A question therefore arises whether the reporting under the clause has to be considered as at the balance sheet date or up to the date of the approval of the financial statement. It is clarified in the exposure draft that the events up to the date of approval of financial statement should be considered for disclosure under this clause. So that one has to keep in mind. Moving on to the another very important disclosure on relationship with stock of companies. So where the company has any transaction with any company struck off under section 248 of the Companies Act. So which means the companies will have to keep such list ready, identify, look at the MCA website and whether there is any transaction with such struck off company, and then make a specific disclosure under these categories, which could be your investment in securities, receivable, payable, shares held by struck off company, and any other outstanding balance to be specified. So whenever any company makes such disclosure, the first thing one needs to think about is the impairment analysis for the outstanding receivables. Entities should assess the status of the company at the time of initiation of the transaction and monitor continuously. And a question also arises whether company is required to give an explanation in a case, in case a name is struck off in the previous year, which means maybe in your previous year, let's say in 2020 or 21, and it's subsequently restored in the current year. To address that issue, the exposure draft clarifies that the companies shall disclose the relationship with the struck of companies evaluated as per the definition of related party under section 2, subsection 76 of the Act. And such relationship between the company and the struck of companies should exist as at the respective balance sheet date, which means for March 2022. And however, when providing this disclosure, the details should not be included for those companies whose name was struck off during the financial year, but an order had been passed by any adjudicating authority, for example, the NCLT, restoring the company's name before the approval of the financial statement. So which means if the name was struck off, but subsequently restored by the NCLT or by an authority before the approval of the financial statement, then that name can be removed from this list. So that clarification is given in the exposure draft. Moving on to the registration of charges. So here, where any charges or satisfaction yet to be registered with the ROC beyond the statutory period, the details of disclosure has to be given. A specified disclosure for compliance with number of layers of companies under section 2, subsection 87 has to be given. Read with companies restriction on number of layers of rules 2017, the name and CIN of the companies beyond the specified layers, and the relationship extent of the holding of companies to be given. So again, that is a specific disclosure required by the for the companies which have to make in the financial statements. Now these are the additions which have been made for all the companies. So earlier, some disclosures are required to be given by the listed companies as part of the SEBI LODR regulation. But now, if you look at the extensive list of the ratios to be disclosed, current ratio, debt equity ratio, inventory turnover ratio, return on capital employed. So every company will have to make a disclosure of the ratios. Also, the company will have to explain the items included in the numerator and denominator for computing the above ratio. And the explanation shall be provided for any change in the ratio by more than 25% as compared to the preceding year. So there was a lot of discussion around the computation, how to compute, and there were a lot of debate around it. So there is an Appendix B or Annexure B, which has been included in the exposure draft of the guidance note, which provides the formulas and the guidance around computation of the standard. As a principle, what is given in the guidance note also, that the computation should be consistent from a year to year. One should look at the industry benchmark as well. And ratios presented in any other place in the annual report should be consistent with the ratios mentioned in the financial statement. This will provide clear picture of the company's financial health and compliance to stakeholders. The items that are considered as part of the numerator and as part of the denominator should be such that a reference to the respective line item in the financial statement or notes could be easily drawn by the user of the financial statement. Also, if you remember, in CARO 2020, the auditor has to report on the basis of the financial ratios that no material uncertainty exists, that the company is capable of meeting its liability as and when they fall due within 1 year from the date of the balance sheet. So which means this will also be used by the auditor to make a specific comment in CARO 2020. Moving on to the next comment on the auditor, compliance with the scheme of arrangement. So currently, the auditor certificate is mandatory whenever any scheme of arrangement is filed by the company with NCLT. The exposure draft clarifies that where an approved scheme of arrangement does not propose an accounting treatment, for example, at many times it is silent, or it simply refers to the relevant accounting standard and the effect is given accordingly in the company's books of account, then a disclosure should be made that the effect of the scheme of arrangement in the books of account is in accordance with the accounting standard. Also, it should apply in a financial year in which a scheme is approved and till such time the balances continue. So if there is a divergence, the deviation has to be given till the time you have a sufficient balance. For example, if you are creating goodwill which is not permissible under Ind AS, and there is a goodwill lying in standing in your balance sheet, then which is pursuant to a quote NCLT scheme, then that disclosure has to be given by the company on a year-on-year basis till the time that balance continues in your balance sheet. This guidance has been again included in the exposure draft. So amendment will increase the understandability of the scheme entered by the companies for the normal users. Now here, again, a very important change, and I will explain briefly about, again, looking at the time, I'll cover up some aspects of the audit report as well here. So this is where any company has advanced or loaned or invested funds or has received any fund from any person or entity, including foreign entities, specified disclosure with regard to the ultimate beneficiaries are required to be given. So for example, if company A has given loan to company B, for ultimately given it to company C. Now C could be a subsidiary, an intermediate subsidiary, or a joint venture associate. So what the disclosures require that if any such amounts have been given to B, then for passing it to C, then it has to be disclosed by the company. So if you look at the funds, now that funds could be your borrowings, your share premium, or any other source. So any amount which you have received from any other person with a clear understanding that you will ultimately pass it on to another entity. So, so that is your ultimate beneficiary. So MCA, by this amendment, is aiming to unveil the ultimate beneficiary behind the camouflage financing. Such indirect funding needs to be adequately disclosed in the notes of accounts of the company. The amended audit rules, which are there in a subsequent slide, also requires the management of the company to give a presentation that except what they're disclosing here, the company has neither employed nor it itself acting as an intermediate entity for any financial transaction. So this is a very substantive and significant change. Also note that this is, in addition to the amendments made in CARO 2020 and the additional reporting by the auditor, wherein you will have to talk about the borrowings from any of the lender, if there is any default, if there is any evergreening of such loans. So also the company will have to declare that relevant provision of the FEMA and Companies Act and the transaction are not violative of the Prevention of Money Laundering Act. There are no non-compliances. So let's look at the wide extensive disclosure and the declaration to be made by the company, which the auditor will also look at whether such transactions have not been violated any of the provisions of the FEMA. The auditor may also have to use the expert in some situation wherever required. So we have looked about the amount of funds received by the company. The company wherein the company has advanced the fund. Similarly, the second clause, subclause, is on where the company has received any fund from any person or entities, including foreign entities, with the understanding that the company shall directly or indirectly lend or invest in other persons on behalf of the funding parties. So again, this is, the disclosure is required where the amount is ultimately passed on to the ultimate beneficiary. So there's an important change wherein the auditor is also required to report. So as I mentioned, the objective is to unveil ultimate beneficiary, indirect funding, if any, to be disclosed in the financial statement. We have existing laws around indirect lending or investment, like Section 185, 186. So amendments to ensure that the companies do not use intermediaries for the purpose of distinguishing the identity of ultimate beneficiary of the funds might also check instances of money laundering. Now, after this important disclosure, I'm coming to some small changes made in the P&L. So if you look at the change here for Indian GAAP companies, total revenue has been substituted by total income. Revenue from operation, they have a new addition in the P&L for the India's company, grants or donation received and relevant in case of Section 8 companies only. Another very interesting disclosure corresponding to CARO 2020, they have asked the companies to make a disclosure about the undisclosed income. So the company will have to make a disclosure wherein they make a voluntary surrender of the income relating to any prior period to the income tax authorities, and the company will have to make a disclosure and make a declaration that these have been properly recorded in the books of account, which means that if a company is under Ind AS and if the amounts pertains to the previous year, they will have to make a restatement as per Ind AS 8, and if it's an Indian GAAP company, they will have to disclose it as a prior period error. One question or the issue which has been addressed in the exposure draft is whether disclosure is required where the addition is made by the income tax authorities, which has been disputed by the entity. The exposure draft clarifies that where the statement is made in the course of search and survey to verify the nature of the income source surrendered or disclosed, then however, such a statement has been retracted on the ground that such disclosures were obtained under force. Therefore, whenever the addition is made by the income tax authority and the company has disputed. So the important point is it has been disputed by the company, reporting under the clause is not applicable because it has to be voluntary surrender. There has to be surrender by the company. So even where the company chooses not to file an appeal, it cannot be presumed that the company has surrendered or disclosed the income. So disclosure format for this clause has been specified in the guidance note. And in fact, you can have a look at the exposure draft. In many places, they have given a disclosure formats also. Moving on to the CSR. So earlier there was a technical guide. We still have a technical guide on CSR, but now they have inbuilt these additional disclosure for all the companies. So you will have to talk about the amount required to be spent by the company during the year, total of previous year shortfall. Now, please note that considering the provision has been mandated from current year, shortfall will be required to be reported from current year onwards. CSR is now a legal obligation after the amendment to the CSR rules, which came in January 2021. And it requires an entity to deposit the unspent amount in specified accounts. So entities need to be careful that business expenses are not misrepresented as relating to CSR. Also, the ICAI has issued the FAQs wherein CSR expenses have to be expensed as incurred, and at the end of the year, a provision is required to be made for the unspent amount. So, so this is again, detailed disclosure requirement for the CSR. Now I'm moving on to the one more important disclosure is on the details of cryptocurrency or virtual currency. So, so this is, in this disclosure, the companies will have to confirm whether it has traded or invested in cryptocurrency or virtual currency during the financial year. And if the answer is in affirmative to this question, that the companies must disclose profit or loss on such transaction, along with the amount of currency held on the reporting date. And lastly, details of deposit or advances from any person for trading or investing in these currencies needs to be separately mentioned. Now, if we discuss a bit about the rationale for addition of this clause, regulators felt that if companies are involved in trading of cryptocurrencies, then there is a need that there should be more transparency about the magnitude and how much money is being made through such trading activities. Investors can have a look at the financial statement with these disclosures if the companies have invested in cryptocurrencies and make the reasons. So this amendment is expected to bring in a lot of transparency. There is no specific guidance currently under Ind AS. Cryptocurrency cannot be classified as a cash balance, and cryptocurrency, if you look at the news report, cryptocurrency legislation is under drafting and which will be released by the regulator in due course. So again, it's a new addition. In the balance sheet, if I look at just quickly, the lease liability, they have added under non-current liabilities, similarly for the current liability. Under other financial asset, they have added bank deposits with more than 12 months maturity. And other financial asset is a complete new heading, which incorporate financial asset that do not fit into any other financial asset category, such as security deposits. On the additional regulatory information, only additional clauses which are not covered by Division 1 have been given here. So this is for your, the company shall disclose as to whether the fair valuation of investment property is based on the valuation by registered valuer. So I think this is on Division 2. Okay, yeah, moving to this, what you call saucy statement of changes in equity. So, the boxes, the red ones which you can see on the slide is what has been added. So changes in equity, share capital due to prior period errors. So restated balance at the beginning of the current reporting period, and they have added all these corresponding items in the previous reporting period. So whether it is due to prior period error, whether it is the restated balance at the beginning of the previous year. So, prior to the amendment, the companies, including NBFCs, required to prepare financial statement as per Ind AS were required to disclose only balance at the beginning and end of the reporting period. Now, post the amendment in Schedule 3, disclosure needs to be made regarding the changes in equity due to prior period error and restated balance at the beginning of the reporting year, and similarly disclose the same for the previous reporting period. Additionally, the details of other equity also needs to be given for the prior reporting period. In the other equity, they have added a specific line item, which is any other changes. So if there are any other changes, has to be made here. Also, for the remeasurement of defined benefit plan, they have added that if it has to be disclosed under a separate column under reserves and surplus for both current and previous reporting period. So these are changes, some of the changes to statement of changes in equity. In Division 3, some additional ratios are required in addition to what you have already seen in a slide. So these are the additional disclosure which are required to be given for your NBFCs and the companies governed by schedule by Division 3. Now I'm coming to some of the more important amendments to Companies Accounts Rule 2014, which will be only this audit trail is applicable from April 22. But now the other amendment will be applicable from 1st day of April 21, which means that in the financial statement, in the board report, the additional disclosures will be included. So if you look at the left-hand side, they have introduced a proviso to Section 128 to Rule 3. Rule 3 deals with the manner of books of account to be kept in electronic mode, which requires that the books of account and other relevant books and papers maintained in electronic mode shall remain accessible in India, so as to be usable for subsequent reference. Now, proviso has been added, which requires every company which uses accounting software, irrespective of the size of the company, nature of the company, wherever they use accounting software for maintaining its books of account, they shall only use such accounting software which has a feature of recording audit trail of each and every transaction, creating an edit log of such change. Auditor will also have to report on this. Now we are in September, I think less than 6 months to go. So companies will have to start preparing for this. And they have to make sure that the changes, whenever the change is made, there is an edit log and the audit trail should not be disabled. Moving on to the next change in board report, which is applicable from current year. So in board report, the following clause have been added, wherein the details of the application made or any proceeding pending under the Insolvency and Bankruptcy Code during the year, along with their status as at the end of the financial year. So, basis plain reading, it indicates that directors will be required to report on the application initiated or the proceedings pending against the companies. Where such an application or proceedings are pending, the board report is also required to contain the status as at the end of the financial year. The aforesaid amendment may be said to be an additional reporting requirement to keep the members as well as other stakeholders updated about the current status of the company. The insolvency is a serious matter which shall not come as a last-minute surprise or a shock to the shareholders when the same is announced publicly at a later point of time. The another specific disclosure to be, or another very interesting insertion in the board report is the details, including the reason for the difference between the valuations of the company done at the time of one-time settlement and that at the time of taking loans from banks or other financial institutions. This is with a motive to understand if there's a difference in valuation of the assets of the company at the time of one-time settlement versus at the time of borrowing funds from the banks and financial institutions. Again, the reason of the changes that is to ensure that the company has not inflated the value of the books at the time of seeking loans from the banks and financial institution, nor has it deflated the same at the time of proposing one-time settlement. So this is an important change for companies as well as for the auditor. So this will lead to more accountability of the company personnel, increase in transparency, and the company should gear up their accounting software that has a feature to record audit trail of each and every transaction. So, so initially they made it mandatory from 1st April 21 for the audit trail. Later on, they deferred it to by a year. So this is just the impact of the change, which I explained. I think I can skip this slide. Yeah. Coming towards the end of the section, the last is about the company's audit and auditors amendment rules. So this is a change, the additional disclosure, which I mentioned about the utilization of the borrowing fund when ultimately to be passed on through the intermediaries to the ultimate beneficiaries. So, so here auditors will have to carry out additional procedures, looking at the schedule, information given by the company. The purpose of the additional reporting is, as I mentioned earlier, is to identify the camouflage lending or investment, that is wherever outbound or inbound loans, advances, and investments are intended to be routed through an intermediaries or a pass-through entity, masking the identity of the ultimate beneficiary. So the provisions are not just casting a responsibility on the directors, but the auditors are also required to substantiate the statement of the directors by applying their audit procedures. While the auditors can have ways and means to identify the instances of such surrogate lending, so this will require additional audit procedures and guidance from the ICAI. So the amendments can also be looked upon as a way to ensure that the companies do not use cover-ups for the purpose of distinguishing the identity of the ultimate beneficiary. This may also help in checking the instances of money laundering. And if you look at the important reporting, so the auditor has to report that whatever procedure auditor considered reasonable by working on, carrying out those procedures, the auditor has to report that nothing has come to their notice that has caused them to believe that the representation given by the management for 1 and 2 contains any material misstatement. So it's not just the management representation. What is important to note here, the auditor also needs to carry out the procedure which auditor believes are reasonable and appropriate in the circumstances. Another change which is applicable from current year, which means for March 22, the dividend declared or paid by the company. So if the company has declared or paid any dividend, then the auditor has to specifically report whether it is in compliance with Section 123 of the Companies Act. And on the audit trail, as I mentioned, that this has been deferred and applicable from 1st day of April 22. So here the auditor has to report whether the company has maintained such software and there's an audit trail facility. Same has been operated throughout the year. So the auditor will also have to report whether the same has been operated throughout the year for all transactions recorded, and the audit trail feature has not been tampered with. So this is quite an onerous requirement on the auditor. Also, the auditor will have to report that the audit trail has been preserved by the company as per the statutory requirements for record retention. So Section 128, subsection 5, requires that the books of account of every company relating to a period not less than 8 financial year, immediately preceding a financial year, or where the company has been in existence for a period less than 8 years, then in respect of such all preceding years, together with vouchers, has to be kept in good order. So which means the minimum, the record retention period as per in Section 128 is 8 years, or less than 8 years if it's a newly incorporated company. However, the auditor will have to report that they have maintained this as per the requirements for record retention. So in addition to the, the edit log feature that it has been operated throughout the year, the auditor will also have to report on the record retention requirement. So, so I'm presuming that probably the ICAI will come up with some guidance around this, but if this will be applicable from March 22, so probably there will be nothing to report on the record retention for with regard to the audit trail for March 22. But yes, when we'll come to March 23, they will have to report whether they have maintained or they have retained the records. So the deferral was made because based on the large number of representation by the companies, and so to give sufficient time to the smaller companies and the MSMEs so that they can transition to the new bookkeeping system. And auditor will continue to use their technology skills, and in this remote audit environment, the virtual world, I think we have learned to use the or maybe better equipped to use the IT tools, and I think this will again require a lot of your IT testing of the accounting software and the audit of the pervasive control using technology. So I think that's where I am coming towards the end of the presentation. I was just conscious of the time, but if there are any questions, we can take it up. Are there any questions? I can't hear you. I think you're, yeah.
Just a moment. Jaldi. Voice is not going. उनकी आ रही है. हमारी जा रही है.
Yeah, now I can hear you. Yeah, it's clear, audible.
Yeah. Ma'am, in case of the NBFC, where the companies gives the jewel loan, in case of aging disclosures, how to report those jewel loans for which auction notice has been initiated after the balance sheet date, that is whether the classified as disputed amount or just overdue.
Okay. So the guidance around disputed has been given in the guidance note, but if the amount is already due as per the terms of the agreement, it should be disclosed as the overdue amount. So it is, if it has been overdue as per the terms of the agreement.
Okay. Ma'am, another question is, government has not clear stand on crypto till now, and what's launched new schedule 3 aspirants to the mention. Its impacts on its books. Is it logical whether ICAI stand on crypto reporting in books and also holds on advisory to NAFRA for listed companies mostly, and also MCA on it for future?
I think a very valid point. And since the legislation is still in progress, I totally agree with whomever has given this comment that we should take it to the ICAI to represent it before the MCA or the NAFRA. So I think I would request, I will take this point forward. I will request you also to send this to the, as a comment to the exposure draft.
Sure.
So we should, because the legislation may take some time, and then one will have to understand the repercussions and the, the regulatory matters.
Yes, ma'am. Madam, whether the title deeds information is to be given even if the PPE is classified in inventory by the company?
No, it's not for the inventory. It's for the PPE and for, yeah.
Okay, it's not for the inventory. Revaluation also to be considered for the change in the method of depreciation?
No, so the underlying principles will not be changing for revaluation. So change in depreciation will not be a revaluation. So that standard application remains, they have referred to the standard. So you will still have to refer to the revaluation standard and the principles.
Okay. Another question by the member. If bank loan is extended to the company based on the property, then LIC policies in the name of the promoter, director, how to report? Question is, if the bank loan is extended to the company based on the property and LIC policies in the name of the promoter or director, how to report this?
So if the LIC policy is in the name of the promoter and not in the company, then it has to be disclosed, in that schedule, clarifying that the loan is to the company, but it is the property or the underlying LIC policy or any property is in the name of the promoter. So maybe it can be mentioned in the same table. So the ED provides the format. So in the others or remarks, you can add a column and provide that information.
Ji. Another question is, ma'am, many companies have a lot of CWIP projects going on at a given point of time. Projects-wise disclosure for exceeding cost or a tenure will be a very detailed information. Will this be a part of value really?
No, I agree. I think I mentioned somewhere in the beginning that it will be really a huge burden on compliance, on complying with the companies and a lot of exercises. I think, but what the regulator is looking from the perspective that the more and more transparent and additional information to be given to the stakeholder or even a person, who's investing money and is from a non-financial background. So I think a lot of representations were already made, but that is something what is required and will have to be given. And therefore, the company should start planning, if they have not looked at it till now, they should start planning from now onwards, looking at their CWIP and how much amount is spending, why it is spending.
Okay.
Yeah.
Another question is, property sold not yet transferred as a registration is pending. How to report this, ma'am? Property sold not yet transferred as a registration and registration is pending.
So registration is pending, so they will have to report it factually. So I'm just trying to think that one is your registration charges clause and property sold not. So this has to be reported as a factual matter. Whatever the situation is at the time of signing of the audit report, that has to be reported as a factual matter.
That has to be reported. Fine. Then these were the few questions for you on the basis of this, your deliberation on Schedule 3 of the Companies Act. So thank you so much, ma'am. We have gained a lot with your wonderful deliberation on Schedule 3 on behalf of all the members and on behalf of Institute of Chartered Accountant of India. I extend my heartiest thanks for sparing your valuable time. Thank you so much, ma'am. More than 2,000 participants are watching and having this your expertise knowledge. Thank you so much, ma'am.
Thank you so much. Thanks for inviting and thanks to the entire committee and to all the participants. Thank you.
Thank you so much. Thank you.
Thank you. Bye.
Thank you.